Good morning, everybody. Yeah. And we are here to discuss the Finance Bill 24, number 224. And before that, may I just thank all of you, the dignitaries on the dais, for this opportunity once again. Yeah. Now, if one is to give an overall comment, I would personally believe that on an overall basis, it is a satisfactory budget with aberrations on both sides. There are some very good points, and there are some which need comment or attention. We are told that simplification is still on the way, and we can probably expect a new code or a new act coming in. And if that be the case, I think if experience is any guide, we can believe that some more complication is on the way. Every attempt at simplification somehow, unfortunately, results into complications. And my firm belief has been that no simplification is possible unless and until there is sacrifice of revenue. So if one wants to retain the tax base without any change and not suffer sacrifice in terms of tax collection, then simplification, to my mind, I may be wrong, is a far cry. Before the budget, we had expectations that there would be something with regard to wealth tax, with regard to MSME, with regard to announcement of Pillar 1, Pillar 2, but we have not heard anything at the moment. But the fact that equalization levy has been withdrawn is an indicator that Pillar 1 is in the offing. It is under some pressure of trade sanctions that EL has been withdrawn in order to create a ground for introduction of Pillar 1 and Pillar 2. There are some provisions which I would like to skip. For example, VSV scheme, Vivad Se Vishwas scheme. I am sure there will be many more seminars organized by the society, and in any case, the scheme is along the line of the scheme that we had some years back, so that's not what I might be touching today. There are some provisions affecting the financial center units in IFSC. It will have limited application and I may not touch. We also have the block assessment scheme coming in. It is somewhat similar to what we had 20 years back, of course. And there are a couple of points which, if time permit, we might touch, but we will not be taking it up in detail. I am sure there will be some seminars from the BCAs on the block assessment scheme. But you find some provisions, like for example, on block assessment, 56 to 7B, indexation, etc., where they were introduced with certain philosophy, and we now find that they have been withdrawn. If we were to compare the reasoning which was given then and the reasoning which is given now, we find it would be contradictory and we may not be able to reconcile. Now, this reminds me of an anecdote concerning Mr. Palkhiwala, which our seniors always used to often narrate. Mr. Palkhiwala, in his commentary, had expressed some view on a matter that he was arguing. But at the time of hearing, he took up a position which was contrary to what was stated in the commentary. So the judges asked him, should we follow you or should we follow the commentary? And he being what he was, he immediately said that there is never a full stop to a man becoming wiser. I think this is exactly what is happening with regard to a couple of provisions which we find on the rollback. Very fortunately, we have not heard any complaint that the provision which is found in the finance bill was the one recommended in the Congress manifesto. Maybe there are some complaints with regard to other schemes, but not with regard to any provision of the finance bill. Now with this, if we were to touch on the rates of tax, the broad changes which are taken place, there are very few changes which directly affect sort of the rate of tax. We will of course deal with capital gains separately, but apart from that, what we find is that in case of salaried employee, the standard deduction has gone up from 50,000 to 75,000. In case of a foreign company, what we find is that the rate of tax has come down from 40% to 35%. And on capital gains, of course, it has come down from 20% in many cases to 12.5% on a uniform basis applicable to almost everyone. Only with regard to FPI and certain securities of FPI, the rate still continues to be 10%. It appears to be a mismatch. I am sure it will be corrected before the law is formally amended. Now, when we look at the table, we realize some small injustice which is done in certain cases. Take, for example, the case of some retired person who may not have any other income, but he has long-term capital gain of say 10 lakhs of rupees. Now, if he had normal income instead of long-term capital gains tax income, then he would enjoy the benefit of first 3 lakhs no taxation, then a certain slab of 5%, then a certain slab up to 10 lakhs of 10%. Now, as against that, if he is being assessed only on the long-term capital gain which he has, then the first 3 lakhs is taken care of, but when it comes to income up to 10 lakhs of rupees, he will have to pay tax at 12.5% and he will not be entitled to the benefit of 5% and 10%. Now, this was there last year also, but the injustice will now be larger this year compared to what it was. Some marginal relief probably may have to be provided. With this, may we turn to changes with regard to capital gains, rationalization of the period of holding, and rationalization, as they call, of the rate of tax. Now, on the period of holding, for listed securities, by and large, we had a provision that it turns long-term in 12 months' time. With regard to listed units of REIT and InvIT, the provision had continued to be 36 months, but it has now been made uniform with the other securities, and it will be all listed securities and units will be 12 months they turn long-term. With regard to real estate, it turns long-term today in 24 months, the shares too, the unlisted ones. Now, jewelry has been included therein. It will also turn long-term in 24 months. But there is one small snag. With regard to a business undertaking, in relation to a slum sale covered by Section 50B, the period of holding has to be 36 months, which continues to be 36 months, it appears to be a slip and may need to be calibrated to 24 months. When we come to the rate of tax, for listed securities, short-term capital gain, which was 15%, now goes up to 20%. It will be effectively 24%. For other short-term assets, it will be the full rate of tax. When we come to the long-term securities, what we find is a uniform 12.5%. Effectively, it will be 15%, and this is against 20%. It was 20% with indexation benefit. Now it will be 12.5% without indexation benefit. There is always a speculation that today you may announce a lower rate and make comparisons on the ground that one is a trade-off against the other. You never know when the rate of tax will rise again and people will forget that there was indexation which was given in the past. Maybe with this come to the point of indexation. Second proviso to section 48 provided for indexation. It's not that in each and every case an indexation was available. There are 5 to 7 provisions where expressly indexation benefit was not available, but that was a small class with which we are not concerned. So by and large, indexation was available. It was introduced in the year 1993, and at that time it was mentioned that in all fairness, in order to offset the inflationary trend and find out the inherent appreciation in the value of an asset, which we can commercially call the gain which we have earned from appreciation, the capital gain, it is necessary that indexation may be provided. Now today we find indexation. We also have a provision that 2001 value of the property will be substituted as the cost of acquisition. Now no doubt the grandfathering benefit of 2001 continues. Grandfathering benefit of the value on 31st January 2018 continues, but no indexation across the board is to be available, and it is withdrawn right from 24th of July 2024. No scope given to anybody to plan the affair, and you find many provisions in this bill which operate right from the date of the finance bill itself. Now, this benefit of indexation we should distinguish from another somewhat similar benefit which is available in the first proviso to section 48. Exchange fluctuation hedge, which is created by computing income in foreign currency and then converting it into Indian rupees. In case of NRI and certain Indian company securities, we find that the first proviso makes a reference of calculation in foreign currency. To the extent, therefore, the gain is represented by currency fluctuation, it is offset, it does not come up for taxation. In addition to that, in those cases where we find that the purchase and sale of an asset is in foreign currency, then by virtue of Rule 115 and the general principle supported by Rule 115, we find that calculation may have to be made in foreign currency and thereafter converted into Indian rupees. Now that part of the hedge continues in all those cases where today, subject to whatever litigation that we have, but today, if you are able to compute capital gain in foreign currency, there is no change which is made by this finance bill. The status and position will continue. That brings us to the third point, and here we find there are representations coming in, complaints coming in. People have not welcomed it, but it impacts all of us as well, namely tax withholding in case of a partnership firm. The provision is likely to apply to all partnership firms, small and big. And we find that there will be a number of firms in the unorganized sector. They will be largely affected, quite possible that they will end up in defaults. So if ease of doing business is a criterion, probably we need a rollback of this particular provision, which we will just discuss. I believe that ease of business is not a concept that the finance minister has reserved only for the non-residents. For the non-residents, at par with non-residents, it should as equally apply to the residents also. And this is a right case where there should be a rethinking. Now, what is the provision? It says that whenever a partnership firm pays any remuneration, interest, commission, bonus to any partner of the firm, he may be working partner, he may be non-working partner, he may be resident, he may be non-resident, but if any amount is paid, then I believe at the time of credit or payment, whichever is earlier, 10% is a rate at which you require tax withholding. Rationale is not given, but we find in case typically of a partnership firm that the data that they are looking for is easily available in the return of income of the firm, in a partnership deed of the firm through which the allowance is regulated, and also otherwise through the medium of the data which is furnished by the partnership firm in the tax audit report. Now what we find is that the tax withholding obligation will relate not only to that remuneration which is deductible in the hands of the firm, it applies to the gross remuneration which may or may not be deductible in the hands of the firm. So what happens is that if a partnership firm pays 10 lakhs of rupees of remuneration, but deductible amount is going to be say 6 lakhs of rupees, then if no tax is deducted, consequences of default of deduction will be with reference to 10 lakhs of rupees. But disallowance under section 40 small a for not withholding tax will be with reference to 6 lakhs of rupees. So 30% of 6 lakhs may come up for disallowance in the hands of the partnership firm. Quite a few practical questions will arise. That say, for example, a simple case would be where monthly remuneration is paid. It is paid within the limit. You pay everything else in the form of share of profit. No tax deduction on share of profit. That would be a simple case of compliance if compliance is mandated. But there are cases where Partners may be having monthly withdrawals of say 2 lakhs of rupees in anticipation that this is likely to be the amount of remuneration. People always believe that this is not credited to capital account, so remuneration is not yet credited. I don't have to deduct tax at source. Possible that the AO will come back and say that what you believe to be the monthly withdrawal is in fact payment of remuneration and you ought to have therefore deducted tax at source. There are quite a few partnership firms where remuneration is determined with reference to the book profit at the end of the year. In such a case, the time limit for compliance people will find difficult because the books will be prepared after quite some months of the year end and it may not be possible to deposit tax in time. I think there is some reconsideration which is needed on this provision. It's an extra compliance which is really not needed. Now this brings us to another important amendment, Section 47, Roman 3. What the provision reads is that if a person has transferred any capital asset through the medium of a gift or irrevocable trust, or if there is transmission of the property through the medium of a will, then in that case, no capital gains is payable. This provision applies today to all the entities. So whether a gift is given by an individual or a gift is given by company or LLP, we find that Section 47(3) does not tax any capital gain. In fact, the commercial and the judicial understanding of the provision as existing today is that the provision is clarificatory in nature. By nature, a gift is a transaction where, if we refer back to Section 122 of Transfer of Property Act, it's a transaction where it is completed without consideration. It does not envisage any consideration at all. No consideration ever becomes due or accrue as a consequence of the gift. And if there is no consideration which accrues, then capital gains is in any case not leviable. We may refer to a recent Bombay High Court decision in case of Jai Trust, where the Bombay High Court expressed a view which I just related, and according to the Bombay High Court, where Bombay High Court, even after considering expressly Section 50CA and Section 50D, took a view that in case of a gift, capital gains is not leviable. So either in case of a gift or when there is transfer by irrevocable trust, we find that no capital gains tax would have been payable. The legislature and the authorities appear to hold a view that but for the exemption, fair value or Rule 11 UA value of the asset would have accrued by way of consideration. It is as if consideration accrues, but because of Section 47(3), capital gains has been exempted. Now, with that philosophy in mind, the provision is sought to be amended, the reasoning being that we can understand gift which is given out of love and affection by an individual or HUF, but a company cannot have LLP cannot have love or affection, and therefore we want to restrict this provision now only to individual or HUF. We will not allow any other entity to be covered by section 47(3). This applies from assessment year 25-26. Now, if our understanding of Bombay High Court decision is correct, then in that case, whether there is an amendment or no amendment, the position will continue to be the same. But one should now be aware that since the thinking of the legislature explanatory memorandum is different, one could be in for litigation if a gift is undertaken by a company or LLP, etc. Also, we must note that there is a distinction, it could be a thin distinction, between a transfer without consideration, which is a gift proper, and a transfer where consideration defined is nil. Where consideration defined is nil, one should be quite cautious because there is a possible view that in such a case, but for the exemption, the fair value or Rule 11 UA value may be substituted either under Section 50CA or 50D as the consideration which accrues to a donor of the property. Now that takes us to the next one. Buyback of shares. Impact of taxability, not only on the company, but also on the shareholders. Let us consider the current position and then we go back to what the change is in, and a number of consequences are likely to follow. A small window of completing buyback before 30th of September is available still, but that would be only a transit mechanism. It would not solve an enduring problem with effect from 1st of October 24. The provision today reads that when there is a buyback of shares by the company, and if I am a shareholder tendering my shares to the company, then every company which buys back the shares and pays consideration to the shareholder, the company will have to pay buyback tax. The buyback tax measurement would be that what the company pays minus what the company had received originally when the company issued the shares to the very first shareholder, the difference will be taxable at the rate of 18.5%. So the company will pay buyback tax and the shareholder does not have to pay any tax at all. Now this is not something where you find that always a shareholder was benefiting, because a person who is tendering the shares, he might have purchased the shares at a very high cost, but nevertheless, under section 1034A, the shareholder was kept outside the purview of present buyback scheme. Now, what is the proposed provision effective 1st October 24? We are told that if there is any buyback of shares on or after 1st October 24, then whatever amount which is paid by company to a shareholder, resident or a non-resident, that entire actual amount paid will be considered to be dividend income of the shareholder. This is regardless of whether company has profit, whether it is buying back out of security premium, whether it has accumulated profit or no accumulated profit, in the hands of the shareholder, it will be dividend. There could be cases where under the Companies Act, company could not have paid dividend, but nevertheless fictionally for tax purpose, what is received by a shareholder will constitute dividend income of the shareholder. Taxability is in the hands of the shareholder alone. Company buying back will not have to pay any tax now. Let us look at a couple of arithmetic. I am a shareholder of the company. I might have acquired the shares at 100 rupees, and at the time of buying back the share I tender the share, I receive 1000 rupees. Now 1000 rupees which I receive will constitute my dividend income, me being the shareholder. No deduction is given in respect of cost of acquisition while determining the dividend income. But the cost is incurred by me. So I am now told that this 100 rupees of the cost which I incurred will be considered to be my capital loss, short term or long term as the case may be. I can't adjust against the dividend income today, but if and when I have some capital gain income, I can adjust against such capital gain income. Second case could be where I acquired the shares from the market at 1000 rupees. I am tendering back to the company is not doing well for 100 rupees. I am in fact incurring a commercial loss of 900 rupees. Now what would be the calculation? 100 rupees which I receive, I pay tax as if it is dividend received. I have suffered commercial loss, but still it is considered to be my income, and 1000 rupees of the cost which I incur will be the capital loss, remains in limbo until such time that through an entry or otherwise I generate some capital loss. Now some question will arise, some challenge can arise, that is it a type and in a hard case where I have suffered commercial loss? If this is the large portfolio, I may not have any scope for adjusting it again in future. So in these cases, what happens? Is it a tax on receipts or is it a tax on income? I have not made profit, I have incurred losses, company does not have profit, and yet there is taxability in terms of dividend income. It will be for the legal fraternity to guide us whether there is any possible challenge which one may like to raise. Now come back to what we were talking. In the hands of the shareholder, amount received is taxable as dividend. If I am a shareholder being a company, if I receive dividend income and in turn I have distributed dividend, then I can take benefit of rollover under section 80M. So a company may not pay any tax on dividend because of the rollover exemption, and yet it should be able to carry forward, set off or adjust the loss which has been granted to it. If the person receiving such dividend is, say, a Mauritius company, it will pay tax at the rate of 5%. And if the shares are not in the grandfathered category, then in that case, it will also be able to adjust the capital loss at some point of time against the capital gains income. There would be tax withholding obligation on the company which is distributing the fictional dividend. A couple of interesting questions will arise with regard to the non-residents. If a person is reconciled that he has to pay tax on dividend income, then he has to be mindful that with regard to the capital loss which he has generated, if they pertain to the grandfathered lot of the foreign company, the capital loss will not be admissible. Just as in case of a transaction covered by 100% holding company and 100% wholly owned subsidiary, covered by section 47(4), there would be dividend taxability, but the capital loss admissible on paper, but will not be possible to be availed by the holding company. With this, we turn to a provision which is a very salutary provision, namely reassessment proceedings. Now we should, for certain, I think, probably acknowledge and grant it that there appears to be sincerity on the part of the finance minister to make the things easy and simple, just as probably it is the system which makes it difficult at times. But a genuine attempt has been made, and it is now sought to be made stronger so far as the reassessment proceedings are concerned, a salutary provision. The provision today is that ordinarily an assessment can be reopened and a reassessment can be carried out within a period of 3 years from the end of the assessment year. So that will amount to 4 years from the end of the accounting or the previous year. This position, which is existing today, continues. Now, what changes is the second limb of the provision. Currently, we are told that while ordinarily the reassessment period is a period of 3 assessment years, in some exceptional cases, namely that there is a case where undisclosed escaped income is 50 lakhs of rupees for a year, and there is tangible evidence available in the form of books of account or an entry or evidence documents, etc., then assessment can be reopened for a period of 10 years from the end of the assessment year. Now, this period of 10 is sought to be curtailed to 5 years. So, effective from 1st September 24, what you will find is that an assessment can be reopened provided Section 148 capital A notice is issued within 5 years from the end of the assessment year, or you can say 6 years from the end of the previous year. Thereafter, the game is lost, and it will not be possible to enter into a reassessment proceeding. It is a different thing, and this is something which is serious, uncertain, not yet settled, that is it possible that while an assessment may not be carried out, somebody may try to raise an issue on prosecution that there is no time limit which is specified in the prosecution section. Very doubtful whether the department can do it, but insofar as reassessment is concerned, we have a fair certainty that reassessment cannot be carried out. The officer has a time till 31st of August to issue the certificate, to issue the notices. But thereafter, and those notices, if once issued, by 31st of August, the proceedings can continue as per old law. But a new notice cannot be issued on or after 1st September 24, except in accordance with the new law. Now, this raises a very interesting situation, which has arisen in some parallel cases. The assessing officer today believes that he has 10 years available for the purpose of carrying out an assessment or issue a notice. Suddenly, abruptly, he finds that the period is reduced to 5 years. Now, he might be holding certain evidence, might be evaluating certain evidence, and he would have had chance to reopen it for quite some time. But here there is an abrupt closure of the power, something of a jet lag. He doesn't know where 5 years get fly. Now, in such a situation, should the assessing officer be left to believe that the assessment proceedings got expired or they lapsed much before he could even imagine that this can happen? Should he be given now at least reasonable time to comply as per the old law? Reasonable time, not 10-year time limit, but reasonable time. And the courts in some cases, not on reassessment, but on certain other provisions, have favored the status and the contention of the tax authority. Are we now told that 31st of August, up to that, you have sufficient time and that will exhaust the reasonable time? Or will the court come back and say that no, reasonable time has to be something larger? Then present provision may continue for some more months, subject of course to a very high-rise litigation which the tax authority will have to undertake. The next topic then is taxation of charitable trust. I think after very many years, this is the first finance bill where we find that there is no adverse provision affecting the charitable trust. There are 3 changes that we find on the chapter of charitable trust. The first change is that supposing there are 2 charitable trusts and both of them are registered as trust under, say, the Public Trust Act. These 2 charitable trusts have objects which are same or similar, and they would like to merge into one, just as there could be amalgamation of companies. There could be formal charity companies, Section 25 or Section 8, whatever that you know as. There are 2 companies having objects which are similar or same, and these companies would like to merge. Under the Public Trust Act, merger is possible. Under the Companies Act, merger is possible. And there was an element of doubt that if there is such a merger, is it possible that the disappearing entity will be subjected to exit tax? And if there is exit tax, it will be with reference to the fair value of all the properties that the trust or the company has. It has now been stated that you need not fear the trigger of exit tax. There will be no levy of exit tax. In the view which we were holding, even without the amendment, there could not have been a trigger of exit tax. But now that there is a specific provision, I think it's always welcome that the uncertainty is mitigated or removed to that extent. The second change affecting the charitable trust, and a very small but a very, very important change. Today, a ridiculous provision that reads is that if a trust has to apply for renewal of its registration, and there is a delay of even 1 day in making that application, it is possible that the trust may lose the registration completely, and there can be a potential risk of exit tax liability as well. There was no power of condonation which was given. Now there is a power of condonation which has been given, and of course it is stated that if you can show the reasonable cause. I think compared to what we had nothing, this is a very good provision. Being a provision which is here to relieve the hardship, we would believe, though subject to what the legal team may confirm, that this might be considered to be retroactive, and even with regard to those applications which are pending today, or with regard to the defaults which occurred earlier, this power can be exercised by the Commissioner. Something much better is required to be done, but compared to nothing, this is a very welcome change. The third change is that look at the current law and then we appreciate the change. Currently, we have two taxation regime in respect of charities. Section 10, 23C, and another is Section 12AB registration. You are either registered and falling within Section 10, subsection 23C, or under Section 12AB. Now, currently under the regime of Section 10, we have people who fall into two categories, the privileged category and the non-privileged category. There are 4 types of trust which are in the privileged category of Section 10. Medical institution substantially financed by the government, educational institution substantially financed by the government, medical institution where the annual receipts are less than 5 crore, educational institution where the receipts are less than 5 crore. Even within Section 10 regime, this category is able to enjoy certain relief. Some of the provisions to be complied with by the other trust may not apply to these 4 categories. That's why I call it a privileged class. For all other entities, even today falling within Section 1023C, the compliance related provisions were almost the same as they apply to Section 12AB registered trust. So the decision which is now taken is that let us try to merge Section 1023C into Section 12AB regime. We don't require 2 regimes if the provisions are the same. So what is now proposed is that the privileged class, the 4 categories of Section 1023C, they can, at their option, continue within Section 1023C. They need not mandatorily migrate to Section 12AB, but for all others falling within Section 1023C, they will have to, in phase, go over to Section 12AB. So the new provision is that if your current registration is expiring, whenever it is expiring, maximum it must have been granted for 5 years. So whenever that registration is expiring, when you are applying for renewal of the registration, you will not be allowed to register under Section 10. You will have to now apply only under Section 12AB. So over a period by 2029-2030, you will find that except for the privileged class, all other trusts will move to Section 12AB category. I think it's just the administrative ease. The people do not have to go through or refer to the compliance provisions for everybody. There is only one study which will apply to all. The next change, which again I think is somebody may call small, but a very important change. Change in the Black Money Act, a draconian provision of Black Money Act. There is a interplay or correlation between the Income Tax Act and the Black Money Act to a large extent. One interplay is that every resident assessee, resident and ordinarily resident assessee, if, so like you and me, if any one of us is holding any foreign asset, immovable, movable or cash, it is required to be disclosed in the return of income that we file. Whether you have acquired the asset out of explained funds or otherwise, there is an obligation. There is an obligation even if you might have obtained the asset out of funds and the transaction is known to the department. Say for example, if I have acquired shares of a foreign company, I might be reporting the dividend income in respect of that every year. Department knows that I am holding shares. But even then, I have an obligation in the appropriate schedule to disclose that I am holding the capital value of the shares. If a person who is resident does not file a return of income and automatically therefore does not disclose the asset, or when he files the return, he does not include this asset as a disclosure in the schedule, then there is a penalty of 10 lakhs of rupees per year, and this is stated to be sort of automatic penalty. One may argue that there can't be any penalty without a reasonable cause, show cause notice being issued is a different thing. But the law as it states is that it's an automated penalty of 10 lakhs that you will have to incur. There was only one exception, namely that if I am holding cash balance in some account outside and the peak value of that balance in a year does not exceed 5 lakhs of rupees, and if I have missed out to disclose the asset, then penalty is not leviable. So a very small window, 5 lakhs, and only with regard to the bank balance which I am holding outside. There have been a number of cases where salaried employee, and most of them would be quite innocent about complications of law, were granted ESOPs by the foreign company. They have been paying tax on the dividend income, but they may not know that such a disclosure is required to be made in the return of income. And there are therefore cases where penalty has been levied or show cause notices have been issued. Probably keeping them in mind, there is now a provision which to my mind is not adequate at all, but still it is much better compared to the position which prevails today. So the position which we now have is that if you have missed out to declare any movable asset or bank balance, if you miss out to disclose immovable asset, old provision continues. But if you miss out to disclose a movable asset or bank balance and the value is up to 20 lakhs in a year, then in that case, penalty will not be leviable. Now, how do we count 20 lakhs of rupees? When it is bank balance, it's little easy to count peak balance of a bank account and convert that into the Indian rupees. But when I have missed out to report a movable asset, how do I calculate the value? What the law says is, if the value of investment is up to 20 lakhs, then penalty will not be leviable. What do I mean by value of investment? And a thought in that behalf. If we refer to the return of income under which disclosure is required to be made, and to the instructions which follow in the return of income, I am told that, and they use the expression same value of investment. So the very same worded expression has been interpreted that to mean that it is INR converted value of the foreign currency which are used on the date of investment, and the rate of exchange which I have to apply is the one which prevailed on the date of investment. Now, can I, for the purpose of interpreting BMA, fall back on the same? I think, to my mind, linkage seems to be a direct linkage, and we should be able to say that 20 lakhs or more or less should be seen with reference to the INR value of my investment on the date of investment. It is possible that on account of currency fluctuation, there might have been a change, what I consider to be 20 lakhs, for the purpose of disclosure in the return of income, might have turned 40 or 50 lakhs today. So that's a small additional leeway which one can look for. Now the next question that will arise is this a provision which is generally for relieving the hardship, a relief provision? And if that be so, can I really rely on Supreme Court judgment in Allied Motors and a range of cases, namely that it should apply also to the pending proceedings? Anybody's guess, but I think good to keep it on mind. The next one, abolition of angel tax. One more case of withdrawal of the provision. And as Anand was saying, this is a current budget and it's circulating on the social media that CS students are very happy with the finance bill today because they find a number of provisions have been deleted. And it's always good that they don't have to study these provisions for their examination. So angel tax provision is one of them. In fact, it is one of those provisions where as we often read, that somebody may want to hit the target. So he hits the target. He may not know what the target is, but having hit, he will verify where is the bullet stuck, and he would say that this is the target that I had in mind. So angel tax was one such provision. The provision is in a way simple, namely that if I am a closely held company, I am issuing shares at a premium, and the amount which I have recovered for the purpose of issue of shares, what I receive is more than what I give. What I receive is more than the fair value of shares which are issued by me. Then in that case, as a company, I have enriched myself, and therefore I should be taxed on income under other sources under section 56 to 7b. If I receive and don't return back to you the equivalent value, I am benefiting, and that enrichment is considered to be my income. Now for this purpose, one had to determine the value of shares which I am giving back to the shareholder. And how do I determine the value? The provision was made applicable to non-resident shareholders also last year, and there are a number of valuation methods which were being prescribed, mind-boggling for a tax professional as well. Now, how do I value the shares? And the commercial perception was always different from the departmental perception. And it said, how do I value a .com company, or a company like Baiju, or a company which is an artificial intelligence, innovation in technology, mind-boggling figures, and we never know why a person contributed to the company, but we had no answer to what the problem statement was. Department also got tired on account of the complaints, and they were not able to find any solution. So they said it's better to withdraw the provision. So what we find from assessment year 25-26 itself, this provision has been withdrawn. Now, is it really good news, very good news, or not so good news? I don't think it is very good news for us. Because if we look at the chances of litigation as will now arise, we will end up in certain other forms of litigation compared to the focus which was on 56 to 7b as of today. There are 2 or 3 points, potential areas of litigation. And I am referring to a case, which is a very hard case, where I am issuing a share of 100 rupees. Everybody believes this share is worth maximum 200 rupees, but somebody comes up and contributes 20 lakhs of rupees for that share. Now, how do I handle the situation? Can I say that section 56 to 7b is not there, and therefore forget whatever that is done? Even if it is a money laundering, so be it, forget about it. But no, I think probably now we are in for some bad news. Before introduction of section 56 to 7b, Department had already issued multiple notices invoking section 68 to say that one has to explain the nature and source of the transaction. Source of the transaction is not enough. Nature of the transaction, according to them, is what it refers to is explain the agenda statement of the transaction. Are you really wanting to contribute to the shares of the company, or is there any hidden agenda in the transaction which you have undertaken? And taking such as the interpretation, they had issued Section 68 notices. If they succeed, now tax will be payable at the rate of 60% because Section 68 prone income is taxable at a high rate. The second could be that whenever an amount is contributed by a resident, Section 68 today says that company receiving the amount has to explain the source of the source. There is no leeway even for a listed company. So long as share is issued to a resident, a source of the source is required to be explained. And the third is department now has the weapon of GAR. And is it possible that the department would now, and I'm referring to a hard case, where everybody suspects that there is a money laundering, in such a case, is it possible that this is a transaction without any commercial substance? Effectively, there is a gift which is given in the garb of share capital. Taxability under Section 56 to 10 is sought to be avoided, and therefore GAR should be invoked. I don't know whether we should ask for restoration of 56 to 7b or whether we should be prepared to face the possible consequences. I hope I am wrong. The next that we take up is Section 201. SSE in default, a tax deductor. If I am a person having to deduct tax at source, and if I fail to deduct tax at source, then I can be considered to be an SSE in default. I had a chance to deduct tax out of your income, but if I fail to do it, and if you run away, then the department will catch me and say that you are an SSE in default. What otherwise would have been the amount borne by you, the payee, I should pay from my pocket to the department and then settle it with you how to recover it back from you. So the concept of SSE in default. Now today the provision says that if I am making any payment to a resident and I am an SSE in default, then notice under Section 201 and proceedings can be completed or initiated within a period of 6 years from the end of the financial year. But 7 years today, 7 years from the end of the financial year. In respect of a non-resident being a payee, I have made payment to a non-resident. There was no such time limit which was fixed up. Though there was no time limit within the section, courts had taken a view, and most of them, that treat a non-resident not worse than in case of a resident, and therefore the same time limit should be applied also in case of a non-resident. Now, what is sought to be done is, number one, that the department itself is now providing for a time limit for a non-resident, accepting the line of court cases, and to say that we want to treat a resident and non-resident payee at par, and therefore in both the cases, the initiation should be within a uniform time limit which we want to have. And secondly, in keeping with the changes made in the reassessment chapter, what they have said is that the time limit of 7 years should now be reduced to 6 years. So 201 proceedings to be undertaken within a period of 6 years now from the end of the financial year. Now, while there is a sincerity, in case of a non-resident, we should keep in mind one more provision which the law is, and that provision is Section 163, a person being treated as an agent of a non-resident. No corresponding change has been made to Section 163, and our representation probably could be that Section 163 should also, in those cases where it has left the time limit open, should be clubbed together with the provision which is now being made. Now, one retrograde provision. The refunds which are due and the unfairness with which the department wants to treat the taxpayers in respect of the refund. We are quite aware of all those cases where we find that a debtor doesn't want to pay to the creditor. And we have a line of insolvency cases where we find that on account of debtors not paying to the creditor, we have the proceedings which are undertaken. Now here we have a case of a debtor not wanting to pay amount to a creditor. There is a justification to some extent, but I don't think there is justification to the extent of an amendment which is now carried out. I don't think this was a necessary amendment to be carried out. When a refund is due, an ideal situation is that you pay it upfront. We were told that if I have to make a refund to you, but if you have to pay some tax back to me, then in that case I will adjust the refund, and I think that's a very fair provision. Then the law was amended to say that I have to grant refund to you, I being the assessing officer, but today there is no liability which you have to pay to me, but your assessment or reassessment is pending. It is likely that there may be some demand which may be raised as an outcome of such assessment or reassessment, and in anticipation that such a liability will arise and you may not pay that liability to me, let me withhold the refund, I don't want to pay it to you. Last 1 or 2 years, amendment was made to that effect, but the amendment was made by containing a protection or a safeguard. That is, you can hold back a refund and not grant it, provided the officer reaches to a conclusion and is able to establish to the court that grant of refund would have adversely affected the interest of revenue, and in addition to that, the officer has to record reasons in writing. So the reasons must bring out his conclusion, his arguments, why he considers that to be prejudicial to the interest of the revenue. He has to make out a case, and the principal commissioner, before he grants an approval, he has to see to it that this protection is available to the taxpayer. Right or wrong, refunds were being withheld, and cases went to the court where the court said that mere pendency of assessment is not good. There is a very high threshold required for an assessing officer to establish that grant of refund is injurious to the interest of the revenue. What is now said is that look, there are two limbs of protection granted to you. One, officer to establish that grant of refund will impact the revenue adversely, and recording of the reasons. The thinking now is that limb of recording of reasons is sufficient. It is so powerful that it includes the first limb also. Why do we spend one line in printing the case law? Let us remove this one limb and purpose will be served by retaining only the second limb. I think this is something which is unfair. As it is, we find that there is a likely abuse of this provision. You were aware that there could be an abuse. Therefore, a protection mechanism was already inserted inside the law. Now, you want to make that provision stricter, as we will just come to. So, there was need for greater protection. Instead of therefore strengthening the protection or retaining the protection, why do you weaken it? If there is no harm in retaining it, and if it can give protection to our taxpayer, it should be a wonderful case to retain the provision rather than to tinker with this provision. The justification doesn't seem to be proper. On the contrary, people will believe that the department doesn't want very willingly to grant the refund, and that is why the provision has been made. The second one is here how it is now made stricter or tightened. Today the provision says that in anticipation of assessment or reassessment, you can withhold the refund. That means that after the assessment or reassessment, it is required to be released. We are now told that you can pass an order to say that refund will be withheld for a period of 60 days after the completion of assessment or reassessment. It is still in progress, not only up to the date of completion, but 30 or 60 days after the date of completion. So in the light of that larger power which has been taken, the protection should have been given. I am not sure whether this amendment was at all necessary, because after completion of assessment, if liability has fallen due, he could have probably invoked section 245(1) and said that I am setting it off against the liability. There was no need to wait for a period of 60 days, but maybe I am missing some reading somewhere, and the provision now is that he takes a power to retain it for 60 days. Now that takes us to probably the last of the amendment which we can discuss as of today. Amendment to section 50 capital A. Last year the provision was introduced, and we were told that if there is a market linked debenture, or if I am holding unit of a specified mutual fund, basically a debt fund, it was defined in a manner where directly or indirectly you came to the conclusion that if 65% of assets are in debt securities, then in that case you find that it's a debt fund and unit of a debt fund was treated alike with MLD. And I was told last year that if there is any capital gain that I get, either from unit of a specified mutual fund or MLD, on transfer or on redemption or on maturity, then such capital gain will be treated as the short-term capital gain and capital gain from a short-term capital asset. Now, effective from 24th of July 24, we find that it has been broadened in a couple of respects. Broadened in the sense that some more items of investment have been added. We are told that along with the MLD, all the unlisted debentures and bonds will be part of the mechanism of Section 50AA. If there is any profit which you make from transfer, redemption or maturity, there is a purpose why they have said redemption, maturity along with transfer, because a possible litigation was that when I receive something on redemption or maturity, it is not pursuant to a transfer, no capital gains tax may be levied, but in order to seal that, we are told redemption, maturity or transfer. So, if any bond was issued such that redemption premium was payable, then now what I find is that the premium payment will be considered to be the short-term capital gain. In some cases, people believe that by such classification, we might be able to get out of the litigation, whether it is interest income or short-term capital gain income. But leaving aside that, the rate of tax, in case of residents at least you will find that the rate of tax would be similar. Now, another change which is made is that a specified mutual fund was defined to cover only a direct investment, but did not cover an indirect investment, namely fund of the funds. So together with unlisted bonds and debentures, we find that investment through the fund of funds is also covered, but there are a couple of deletions where gold fund, etc., were regarded as erroneously covered, and we find that they will now get out of the provisions of Section 50AA. One last point which we may have while on Section 50AA is that we are aware of courts having taken interpretation on Section 50 on language similar to the language which has been employed in Section 50AA. Same language occurs also for depreciable assets in Section 50 and capital gain arising from disposal of the assets. Now, we have litigation with courts at times taking a view that so long as an asset is a long-term capital asset, how far do we read Section 50 to say that the fiction of Section 50 is all pervasive, but courts have said that it will apply to a limited purpose, but may not apply to some other situations falling within the law. Can we have the same view also for Section 50AA? Certainly something which is against the legislative intent, and it's only subject to high-rise litigation that one can attempt to look at any such argument. I am aware that there are some other provisions of the law, but they are all matters of details, and it would not be possible for us to cover up all of them. But I think important ones, what I consider to be important, we have been reasonably able to cover up. So how do we read the budget at times? And despite the sincerity on the part of the Finance Ministry, what we find is that there are some injuries which are caused, maybe unintended, but they have been caused. So it's something like what we had coming from Mr. Churchill in one of the debates. He said, while arguing with the opposition, he said that the last thing which I have on my list is to hurt you. He said, I don't want to hurt you. That is the last thing. The last thing which I can do is to hurt you. But remember, it is still on the list. So what we find here is that yes, we are still on the list. There can be provisions which hurt us. Thank you so very much.